Inflation does not knock on your door. It does not send you a bill. It does not announce itself loudly. It works quietly, slowly, relentlessly, and over time it transfers wealth from savers to borrowers, from workers to asset holders, from the cautious to the leveraged. Most people think inflation is rising prices. That is the visible symptom. The cause is monetary expansion. When more currency enters the system than goods and services, purchasing power declines. Each unit buys less. Your paycheck may rise, but your real purchasing power may not. This is why inflation is called a hidden tax. Governments do not vote on it publicly. There is no explicit legislation titled wealth transfer, yet the effect is measurable. Consider a simple example. If you hold $100,000 in savings, and inflation averages 5% annually, after 10 years, that money has lost significant purchasing power. Even if the number in your account remains the same. You worked for that money. You saved it. You deferred consumption. But the currency itself changed. Now consider debt. If you owe money at a fixed interest rate, and inflation rises, the real value of your debt declines. You repay with cheaper dollars. Borrowers benefit. Lenders lose. This dynamic shapes policy incentives. High debt governments often tolerate moderate inflation because it reduces the real burden of obligations. Citizens holding cash absorb the cost. Now connect this to quantitative easing. When central banks expand the money supply aggressively, asset prices often rise first. Stocks increase, real estate appreciates, commodities climb. Those who own assets see gains, those who hold cash see erosion. Inflation is rarely neutral. It redistributes, but it does so invisibly. There's no direct invoice, no immediate shock, just gradual adjustment. Rent increases, groceries rise, energy costs fluctuate upward, education becomes more expensive. Healthcare expands in price. Over time, households adjust expectations. They normalize decline in purchasing power. They assume rising prices are natural. But historically, stable currencies did not lose value continuously. Debasement has ancient roots. In the Roman Empire, rulers reduced silver content in coins. Coins looked the same, but contained less precious metal. Citizens did not notice immediately. Over time, confidence eroded. Prices rose, trust weakened. The pattern repeats across centuries. Currency expansion funds spending. Spending stimulates activity, but expansion eventually pressures prices. Inflation is rarely dramatic at first. It creeps, it compounds, it accumulates. Inflation is not only about numbers, it is about expectations. Modern central banking operates on a powerful assumption. If people expect inflation to remain moderate, behavior remains stable. If expectations rise, inflation accelerates. This is why communication matters almost as much as policy. Central banks do not simply adjust interest rates. They guide perception. They publish projections. They issue forward guidance. They reassure markets. They shape narratives. Because inflation is partially psychological. If businesses expect higher costs, they raise prices preemptively. If workers expect higher living expenses, they demand higher wages. If investors expect currency erosion, they shift capital into assets. Expectations become self-reinforcing. Controlling inflation therefore means controlling belief. Now consider how inflation is measured. Governments use price indices, consumer price index, personal consumption. Expenditures index, core inflation, measures that exclude food and energy. These metrics are statistical constructs. They use weighted baskets, substitution adjustments, hedonic modeling, technical calculations. The average citizen does not calculate these adjustments. They feel lived reality. If rent rises 12%, if groceries increase sharply, if healthcare premiums climb, their experience differs from official percentages. This gap between measurement and perception creates tension. Now return to policy incentives. Governments carry enormous debt loads. Higher inflation reduces the real value of that debt. But uncontrolled inflation destabilizes society. So central banks aim for moderate inflation, often around 2% annually. Why 2%? Because small inflation encourages spending. It discourages hoarding. It slowly reduces debt burdens. And it appears manageable. Over decades, however, 2% compounds significantly. At 2% annual inflation, purchasing power halves roughly every 35 years. This means a lifetime of savings gradually erodes, unless invested, which pushes individuals toward financial markets. Inflation encourages risk-taking. It penalizes idle cash. This is not accidental. It channels capital into productive or speculative activity, but it also amplifies inequality. Those with financial literacy and asset access benefit. Those without remain exposed. Now examine wage dynamics. Inflation often rises faster than wages in early stages. Real income declines. Households rely on credit, debt expands, financial fragility increases, eventually wage pressures build. Central banks respond by raising interest rates. Higher rates slow borrowing. They reduce spending. They cool housing markets. They pressure employment. This is deliberate. Controlling inflation often requires slowing economic activity, sometimes triggering recession. This is the hidden trade-off. To defend currency stability, growth may be sacrificed. But political tolerance for recession is limited. So policy timing becomes critical. Raise rates too slowly, inflation accelerates. Raise rates too quickly, markets panic. Modern economies, therefore, operate within a narrow corridor. High debt, high asset valuations, high expectations, and policy must navigate carefully. Inflation does not destroy wealth equally. It reallocates it, quietly, systematically, predictably. To understand this, imagine two individuals. One holds savings in cash, the other holds assets. If inflation rises, cash loses purchasing power. Assets often increase in price. The saver loses ground. The asset holder gains relative advantage. Now scale this to an entire economy. Governments borrow trillions. Corporations issue debt. Homeowners finance property. When inflation rises moderately, real debt burdens shrink. Debtors benefit, creditors lose. Who are the largest debtors? Governments, large corporations, highly leveraged investors. Who are the largest holders of idle cash? Households, pensioners, low-income savers. The structure becomes clear. Inflation acts as a transfer mechanism. From currency holders to asset holders, from wage earners to leveraged investors, from fixed income retirees to equity participants. This does not mean inflation is always malicious. Sometimes it stabilizes crisis, sometimes it prevents deflationary collapse, sometimes it stimulates recovery. But it is never neutral. It reshapes distribution. Now consider long-term compounding. If inflation averages 3% annually for decades, savings lose significant real value. If asset prices grow at 8% annually during the same period, wealth concentration accelerates, not because individuals work differently, but because capital compounds faster than currency. This is why financial literacy matters. Understanding inflation means understanding that holding only cash is rarely sufficient. But it also reveals systemic bias. Modern monetary systems are designed to encourage participation. Participation in markets, participation in debt, participation in financial risk. Opting out becomes costly. Remaining outside the asset system means a gradual erosion. This creates dependency on markets, which increases volatility exposure, which increases anxiety, which increases demand for policy stabilization. The cycle reinforces itself. Inflation also affects trust. If citizens believe currency loses value persistently, they seek alternatives: gold, real estate, foreign currencies, cryptocurrencies, commodities. This diversification reflects doubt. Confidence in money is foundational. Once confidence weakens, stability requires intervention, which may require more monetary expansion, which may trigger more inflation. This feedback loop is delicate. Throughout history, currency debasement often preceded social unrest, when purchasing power falls sharply, when wages lag behind prices, when savings erode, when essentials become unaffordable, political pressure builds. Leaders face difficult choices: tighten policy and risk recession, or tolerate inflation and risk instability. There is no painless option. This is why inflation is described as a hidden tax. It funds deficits without explicit legislation. It reduces debt without formal restructuring. It transfers purchasing power without visible confiscation. It changes behavior without direct mandate. Understanding this changes perspective. Inflation is not random. It is structural. It emerges from policy choices, debt levels, monetary expansion, supply constraints, expectation management. It is shaped by incentives, and incentives reveal priorities. If growth is prioritized, inflation risk increases. If stability is prioritized, recession risk increases. Modern economies constantly balance these forces. For individuals, the lesson is not fear. It is awareness. Holding only cash invites erosion. Holding only assets invites volatility. Diversification becomes survival. Understanding cycles becomes leverage. Inflation will rise and fall. Policy will tighten and loosen. But the underlying mechanism remains. Currency expands, purchasing power adjusts, wealth shifts, and those who understand the structure navigate it better.